Welcome to the Deep Dive. Today we're peeling back the layers on Synchrony Financial's second quarter 2025 earnings report. And just as importantly, we'll dig into the insights from their recent conference call. Our mission really is to unpack the core financial results, the strategic moves they're making, and their outlook. This isn't just reading numbers, it's about figuring out what truly matters to you. Maybe you're catching up on financial news, prepping for a meeting, or just curious how a major consumer finance company is doing these days.
Exactly, because it's not just about the raw figures. There's a fascinating story here about the underlying trends and the big decisions they're making. What jumps out immediately is this interesting contrast between their strong reported financials and some, let's say, shifts in consumer activity. It really gives you a compelling window into consumer finance right now.
Okay, yeah, let's unpack this because the top-line results for Q2 2025, especially compared to last year, are genuinely striking. I mean, net earnings surged, 50% to $967 million.
50%.
And diluted earnings per share jumped pretty significantly from $1.55 to $2.50.
Right.
Return on assets, that increased by 100 basis points, a full percentage point to 3.2%.
Yep.
And return on tangible common equity, ROTCE, impressively rose 8 percentage points to 28.3%.
That's a big one.
Plus, book value per share up 17%, tangible book value per share up 18%. All looks very positive.
Very strong indicators, absolutely.
But, and this is where it gets interesting, you look at some operational metrics, and they seem to tell a bit of a different story at first glance.
Right.
Despite those really strong financial gains, purchase volume actually decreased by 2%, down to $46.1 billion.
Yeah.
Loan receivables also decreased 2% to $99.8 billion. And average active accounts decreased 4% to 68.1 million. So, okay, how do we square that? Booming profits, great returns, but fewer loans and fewer active accounts. Is the market shrinking, or is this something else?
That's the crucial question, and it really points to a fundamental strategic choice they've made. The strong earnings, even with lower volume, seem to come down to two main things: those product pricing and policy changes, or PPPCs as they call them, and significantly better credit quality. See, Synchrony tightened up its lending standards, what they call the credit aperture, between mid-2023 and early 2024.
Right, they took specific actions then.
Exactly. It was a very disciplined approach. So the loans they are making now are higher quality. And the result: lower charge-offs, fewer delinquencies, which boost the bottom line, even if the overall volume or account number is down. Their CFO, Brian Wenzel, he put it quite clearly. He said their credit trends continued to outperform relative to the industry and our original outlook.
Okay.
And he directly tied that to their disciplined and effective approach to underwriting and credit management. So it's not just a minor adjustment. It looks like a shift away from just chasing volume towards really prioritizing profitability.
Quality over quantity, essentially. That makes sense for the profitability side. And if we dig a bit deeper into those operational numbers, there's some interesting nuances within those decreases too, like dual and co-branded cards. Their purchase volume actually increased 5%. They now make up 45% of the total volume.
Right, that's a key segment for them.
And average transaction values, they were only down about 0.5%. 50 basis points. That's a lot better than previous quarters.
Definitely an improvement.
Plus, customer transaction frequency actually ticked up by about 3%. So what do these little shifts tell us about how people are spending?
Well, they sort of paint a picture of what the CEO called a discerning customer. People are being more selective, given the uncertain economy.
Sure.
But what's fascinating is that Synchrony saw this gradual uptick in discretionary spending as the quarter went on. Strength coming from places like restaurants, cosmetics, electronics. It suggests maybe a subtle shift in consumer confidence. Even if cautious, people are still spending, just more thoughtfully. And because Synchrony adjusted its credit focus, those thoughtful engagements are proving more profitable for them. It's like watching adaptation in real time.
This disciplined approach, it really leads us straight to their credit quality numbers, which, well, they are pretty remarkable.
They really are.
Loans 30-plus days past due dropped 29 basis points to 4.18%. And that's, 10 basis points below their 2017-2019 average?
Right, below the pre-pandemic average.
And net charge-offs, down 72 basis points, that's almost 0.75% to 5.70%. Also 10 basis points below that historical average.
And these figures are, the direct result of those credit actions they deliberately took back in mid-2023, early 2024. They pulled back.
Okay.
Now, interestingly, because the credit performance turned out even better than they expected, they've actually started to selectively unwind some of those tighter rules.
So they're loosening up a bit now.
A bit and selectively. For instance, they mentioned opening up the credit aperture again in certain areas that are performing well, like health and wellness. It's also telling that the newer loans, the 2025 and 2024 vintages, are apparently performing better than older ones, like the 2018 vintage.
Which validates the strategy, I suppose.
It does, but it also raises that important question. How do you balance that? How do you ease up to encourage growth without, messing up the great credit quality you've worked hard to achieve?
Yeah, that's a tricky balancing act.
It really is. They seem to be taking it quarter by quarter, watching the environment closely.
Okay, so beyond the numbers and the credit side, Synchrony's been really active strategically. Some big partnership news.
Definitely.
They renewed their long-standing deal with Amazon, 15 plus years now, right?
Hmm.
And launched Synchrony Pay Later for smaller transactions, $50 plus.
Mm-hmm. Part of that multi-product approach, private label, secured, DNPL.
And then the huge one, the new partnership with OnePay to exclusively power a new Walmart credit card program launching this fall.
That's a major win.
Yeah, includes a general purpose card and a private label one, all
Yeah.
built into the OnePay app apparently.
Mm-hmm.
Very digital first.
Right.
Plus, they expanded the PayPal credit offering. Now there's a physical card. You can use it anywhere. Get 6-month promo financing. They even had a travel offer.
And if you connect these dots, these renewals, and especially the new wins like Walmart, they're absolutely vital for their long-term stability.
Locks them in.
Exactly. They pointed out their top 5 partner deals now run out between 2030 and 2035. And get this, 22 of their 25 biggest programs go beyond 2027. That covers something like 98% of the interest and fees from those top partners.
Wow, that's significant stability.
It really is. It gives them a very strong foundation to build on and innovate from. It cements that partner of choice reputation they aim for.
That's a powerful position.
Hmm.
But strategically, how do these innovations, the multi-product thing, the seamless digital stuff with Walmart, how does that actually help the partners drive loyalty and sales?
Yes.
It's more than just a card, right?
Oh, absolutely. It's really about meeting the customer wherever they are with the right option. Having that whole suite private label, maybe a secured card for some, BNPL for others, lets Synchrony cater to different needs, different purchase sizes, right at the point of sale.
More flexibility.
Exactly. And that flexibility isn't just nice for the customer, it genuinely helps the partner. It reduces friction, makes it easier to say yes to a purchase, and opens up financing to more people. And when you embed it right into an app, like with Walmart OnePay, it becomes almost invisible, super seamless. That encourages use and makes financing just part of the shopping flow. That's a real advantage for the partner.
Okay, so strong strategy, improving credit. Let's look at the foundation supporting all this, the balance sheet, capital management.
Right, the financial bedrock.
Deposits are at $82.3 billion, making up 84% of their funding. That sounds pretty solid.
Very solid. Deposit funding is generally seen as more stable and lower cost than wholesale funding.
Total liquid assets grew 9% to nearly $22 billion. That's over 18% of their total assets.
Good liquidity cushion.
And they returned a good chunk of capital to shareholders, $614 million this quarter. $500 million in buybacks, $114 million in dividends.
And still $2 billion left in the buyback authorization.
Plus, strong capital ratios. CET1 ratio is 13.6%, up 100 basis points from last year.
Yeah, these numbers are significant. They really signal financial resilience and that commitment to shareholder returns. High deposit funding means less reliance on potentially volatile markets. Strong liquidity means they can handle surprises. And that 13.6 per CET1 ratio, that's comfortably above regulatory minimums. It gives them a strong buffer, room to grow, and capacity to keep returning capital. It shows confidence.
Okay, so that strong base gives them a clear path. What about the outlook for the rest of 2025? What are they projecting?
Well, they expect ending loan receivables to be roughly flat compared to last year.
Okay, so not expecting big growth there.
Not in overall volume, no. They do expect the payment rate to stay elevated, though, and the loss rate projection is between 5.6% and 5.8%. That's comfortably within their long-term target range.
And net interest margin, the NI.
They see that increasing to an average of 15.6% in the second half of the year.
What's driving that increase?
Mostly those PPPCs we talked about, improving the yield on loans, combined with potentially lower funding costs and just a more efficient mix of assets.
Got it. They also gave revenue guidance.
Yeah, net revenue expected between $15 billion and $15.3 billion, and an efficiency ratio between 32–33%. That ratio is a bit higher, partly because of the costs of launching the big Walmart One Pay program.
Right, investments cost money up front.
Exactly. And these projections really reinforce that disciplined strategy. The PPPCs are becoming, as they put it, normal course pricing talks with partners now. They estimated the impact from any potential rollbacks of those changes would be less than $50 million in net revenue, which is pretty small overall.
So steady focus on profitable growth, not just growth itself.
Seems to be the plan. Lean into quality segments, operate efficiently.
Okay, one last piece. The engine behind a lot of this seems to be technology, especially AI.
Yes, they talked quite a bit about that.
Mentioned an internal Synchrony GPT for employees, using Gen AI for customer service, and even using it to drive top-line growth, like helping customers search marketplaces for specific furniture styles using AI. That's interesting.
It really is. They emphasize that technology, along with their credit underwriting skills, are key differentiators when they compete for business.
So it's not just buzzwords.
Apparently not. The CEO basically said this is how they win deals. It's about integrating these tools deeply faster, smarter underwriting, personalized service at scale. It builds a competitive advantage that's hard to replicate, especially using data effectively. And it enables these new partnerships like the Walmart one, which they said will be one of the most technologically advanced programs they run.
All embedded in the app.
Exactly. Seamless digital experience.
So wrapping up, the CEO kind of boiled it down to 3 key takeaways.
Okay.
First, their credit trends outperformed, giving them a strong base for returns. And while they're easing up slightly, they're watching things very closely.
Right. Disciplined performance.
Second, their business model, diverse products, digital solutions, gives customers flexibility and drives sales for partners. Win-win.
Value proposition.
And third, they see themselves as the leader in private label and co-brand, well-positioned to deliver returns to partner wins and just solid execution.
Market leadership and execution. Makes sense.
So considering all this, the strong credit, the strategic pivots to multi-product, the big tech investments, here's something to think about. How might these moves by a major player like Synchrony start to shape the wider consumer finance landscape? And, what could this mean for how you access and use credit yourself in the next few years? Definitely something to ponder. Thanks for joining us for this deep dive into Synchrony Financial. We hope you're walking away a little more well-informed.